Well, hello everyone. It's Ken Winans and Stephanie Larson from Winans Investments, and we hope you all had a very good holiday season. And boy, January has flown by. I do want to say one thing. One of the reasons we held up on this video was because of the Los Angeles fires. For our clients in Southern California, Godspeed and our heart goes out with you. Many of you know that I grew up in Big Bear. I know about the fires and the earthquakes, and I truly do understand what you're going through. So Godspeed, and please let us know if there's any help you need. I would say very quickly on that if any of you are in emergency need of money, do remember you have margin in your investment accounts that you can tap into without any pre-approval or line of credits. Just let us know if we can help. With that being said, let's go ahead and start in with our investment video. Number one, the year, as many of you probably know, I've done extensive studies on market seasonality, not only in stocks and bonds, but also in commodities. I track it very, very closely. January sets the tone for the year for a couple of different reasons. Number one, this year is obviously a change in the presidential administrations, but there's many, many other things that happen in January. The Federal Reserve comes out with their guidance on what they see for the year in interest rates. The Treasury Department is going to very soon tell us what the borrowing needs are going to be. Many of the state capitals also come out with their budgetary needs for the year. And then last but not least, and the big one, are earnings, corporate earnings. I think it's 83 or 84% of the S&P 500's companies have a calendar year reporting, which means their fiscal year ended December 31st. The only thing I would tell you, it is very interesting, and it really ever since COVID's been this way, earnings season has shifted. And what I mean by that is where companies we'd have the vast majority of earnings done by the end of January. Stephanie and I were talking about it. That is now happening in mid-September, or excuse me, mid-February. So I'm calling it the Valentine's Day filing of earnings. Steph, you want to add anything to that? Or?
Earnings has started a little bit, only like 10% of the S&P 500 is reported so far. Financials have, and they're broadly strong. We were very happy with what we've seen. There was no big surprises that we saw. I will say though, as a start, Ken's right about January. January is the January effect is a real thing, and we do pay attention to it. We were a little disappointed with the lack of a Santa Claus rally, but not really, because from the time of the election until really Christmas, the market had a massive rally. Coming into the new year on the back of a soft Santa Claus rally, January really did pull back to start. We were being very conservative. We cut a lot of companies that we weren't happy with. They were deteriorating. We rotated a little bit.
We took profits.
We did tax loss harvesting at the end of the year, where we could, when we could. After 2 strong years, though, it's kind of hard to do tax loss harvesting. There wasn't a lot to really harvest from, but we did what we could. And now that we've seen, I think, a demonstrable shift in leadership, where they've really no, that these are the ones that are going forward. As of today, you'll see the trades come across your email. We've committed. We took the hedge off. We've committed the cash, and we're going to go after this market until it tells us not to, essentially.
Yes, and it's important to remember, for many of you who were with me in 2017, there was a shift in the type of stocks that moved up, and we saw a similar shift here, even though it did start earlier last year. What I would say is this: as bear markets age, and this is an older bull, I mean, we're going to go in for a 3rd year. There are a couple of things I can tell everybody. Number one, volatility typically does increase because valuations do get stretched, and also there are changes in leadership. This is actually good. A broadening of the market participation, which now is going to include industrials. Stephanie and I believe financial stocks are actually going to lead the year. When you're talking about, banks taking on more of a role, and especially now with the crypto situation, there's a lot of things going on there that the banks are now going to be able to go into. It's not a political statement, it's just reality. There's deregulation. Banks are going to be allowed to go into some other areas. I also think, too, because the dollar is so strong, American banks or American domiciled banks are they're in the lead in the world right now when you compare the news out of Canada, Europe, Japan. I mean, Japan's having terrible problems right now with their currency. So the point being, we're in a very dominant position.
Yeah,
So
I would agree with that. I would also say that if you actually look at some of the international countries like China, for example, I would actually argue they're in a pretty bad recession. They'll fudge the numbers, but I actually think that there's a lot of European countries that are struggling with it.
South America.
South America, definitely some Asian countries that are struggling. China's one of the largest ones. They're trying to export their way out of it, which is kind of a weird thing to do, but they flood the market with cheap goods. So it's very interesting to see how the international players, obviously our neighbors to the north with Trudeau stepping down. I mean, it's a very interesting political time right now in the world. And then with the new regime change in our country and potential for potentially for tariffs. I mean, it's something that Ken and I are very aware of. We want everybody to know that we're thinking about what's going on. Our focus is the markets, and we're going to let the markets dictate everything. But I would say that the U.S. economy companies, I do feel are in the pole position to really, outperform. And you'll see that by how much foreign investment comes into the U.S. And I think those are numbers that we're going to kind of track and watch and see what happens.
Yeah, I would just say very quickly, as many of you know, the company actually, although we have a staffed office in Novato, the headquarters has actually moved to Las Vegas. And as I've gotten to get to know business leaders, and actually surprisingly, there's a lot of trade offices set up in Las Vegas. And as I get to talk to these, 19 different countries, and I go to these events and I talk to these people, very much they are looking at how to do more business in the United States. A lot of the sovereign funds of these, I just heard this, or actually over the weekend, a lot of the sovereign funds, especially out of the Middle East, are sending money to the United States. Mm-hmm. So they're not putting it in China, they're not putting it in South Korea, they're sticking it in the good old USA. So we have all that. A couple other quick things. We're going to we have a lot to talk about, and we're hoping you will all contact us. We always encourage to have first quarter meetings with our clients, mm-hmm. even if it's just a phone call. I would much prefer that we be able to talk things. Also, any of you who want to talk about possibly changing your portfolio allocation, your portfolio mixes, let's have a talk about this before we do a knee-jerk thing. But a couple of other things. So, number one, inflation is still going to be an irritation in the U.S. economy. Mm-hmm. The inflation is actually much better here than in most parts of the world, but it's still, I think all of you listening, especially many of you who are old enough to remember the 70s, it took a very long time to get it out of the system. Mm-hmm. And at this point, Stephanie and I are just saying, hey, I hate it for young women with a young family. I wish it wasn't there, but that is the reality. Sure. So what it does mean is that you're not going to see interest rates meaningfully go down this year. I think anybody thinking about buying real estate, any business investment, you're going to have to just operate with it. But the good news is that your tax deductibility of those interest charges mm-hmm. are lower. So if you actually take the tax deduction out of what you're paying, it actually is not bad.
Yeah,
it really isn't.
And I would say Powell has kind of hinted at that in his guidance that they're going to really slow it down. They're going to let the numbers show maybe a cut this year, maybe two. They're going to be very judicious about how they're doing it. I will say, though, they are going to achieve the soft landing. I mean, that was kind of their goal this whole time. They didn't shove the country into a recession. They're trying to not really oscillate on their, like I cut now and now I have to put them back and I have to cut again. So
we don't want that.
Yeah, they're trying to be very measured about it, which is not a bad thing. Obviously, financial institutions and investors would love to see some more rate cuts, but I think they're going to be judicious about it. He's pretty much said that that's what he's going to do. So don't be surprised if that's how the year plays out,
And they are committed to shrinking their balance sheet, which they have to. So these are all, we're going through a massive reset. A lot of it's post-COVID. Some of it goes way back to 2008, 2009. It's long overdue. We're making those changes. Okay, so one quick thing. Anybody who has bonds in their portfolio, what you really want to go back and remember, and please read our books on it, it's very important, what bonds and quite frankly preferreds are best at is producing income. Mm-hmm. That should be what you focus on, not what value the bonds are at on any given moment in time. Mm-hmm. We know that 2022 is still a harsh memory for many of you. Mm-hmm. We're not going to have that happening, and highly unlikely that will happen again. But the point being, when you have bonds in your portfolio, you just need to realize the real value, the real return is your cash flow there, not on what the total return is not something Stephanie and I worry about. Mm-hmm. I'm of the opinion, since banks do issue the bulk of the preferred stocks that are out there. For many of you who might not know what these are a type of security. They're kind of like a bond, they're kind of like a stock, they're kind of in between. But the reality is most financial institutions issue these. They're going to issue a lot more of them. So that will be a growth.
Yeah,
there.
they're one of the primary issuers of prefers, not the sole by any means, but they do a lot. It does help with their flexibility with their book. It's interesting on the fixed income side. So everyone should have their overviews. They were sent out a couple weeks ago. They're posted to your portals. I hope everyone has seen them. Take some time if you have fixed income in your portfolio to go through the bond section, not the holdings, but the actual bond section. It'll tell you the interest that it pays, how much you should receive every quarter. It also will give you certain mnemonics like yield to maturity. So you have two values on your fixed income. You have your coupon rate, which is what it's going to pay you semi-annually, through the life of the bond. But then you have the yield to maturity, which is the difference between the discount that I buy the bond at and the maturity value, which is 1,000, right? Plus the coupon. So say the coupon pays 5, but your yield to maturity is actually 7.5. So it's important to really understand what your portfolio is generating. I'm happy to walk anybody through those pages if they have some questions about it. But they're still hitting 7. I'm not having to get really scary paper or go really far out to kind of stay in that neighborhood. The 6.5 to 7.5 is the neighborhood I'm trying to stay in. If you go out and get more yield, 8, 9 plus, it tends to be scarier paper. So we try not to go. We're not doing that.
We're not hired to buy that kind of stuff.
No, we're not. So but the fixed income side is still strong. I haven't seen a lot of calls in the last couple months, which is great. That's really slowed down, which would be really helpful. So I feel like the fixed income side is still really strong.
But I would just say also for many of you who have been with me for a very long time, and for Stephanie, for a long time, the average maturity in a bond portfolio was about 6 years. You're still way below that. You should all expect that these bonds, we will migrate the average maturity out gradually, but you're going to expect that because we are concerned that in an inflationary environment, we have got to make sure that you make enough to not only cover the inflation bill, but you also our job is to keep your money whole. That is our mandate. Yeah. And so we just don't see that. I worry when people get so fixated. Like, I know a lot of people here maybe at times have looked at municipal bonds. Again, when you back into the inflation and what you're actually getting and how far out you have to go, and then you deal with what I see as serious credit risk right now in many states running horrible financial situations. It just doesn't make sense. It just honestly doesn't make sense.
I do concur with him on that. I'd also say that if you have money sitting on the sideline, like, maybe the market's a little scary for you, or you're uncomfortable with maybe the election cycle, you're just like, I don't know what's happening. Right now, the money markets have come down quite a bit. You're getting under 4, and which is a normal amount on money markets. It actually should go down a little bit more, to be honest. Money on this side is losing money. Inflation is still around 3, and so money markets are barely keeping up with it. If I can get 7 or plus, I feel like if you have money on the side that you don't need, you should put it to work. Otherwise, it's just losing money. Yeah. So.
Listen, I know this video is going a little long, so we just want to give you an overview that Stephanie and I are generally optimistic about the year. It's going to be volatile. There will be ups and downs and bumps, but so much for that. So a couple of quick things. As I've met with people there, and again, I understand when there's change, there's also can be some confusion. I want to make sure this is very, very clear. Stephanie and I co-portfolio manage the portfolios. We talk all the time. I think she talks more to me than her husband. Okay, so yeah, I do. So no, please, just because we're in different locations does not mean that we're in bubbles. Yeah. We're very much in tune with the markets. Yes, it is true that I am in Southern California quite a bit with my radio show. That's every other week. I'm in my office in Las Vegas most of the time. I'm going to be coming out to Nevada probably every 2 to 3 months. I'm going to be down in Los Angeles and Orange County and San Diego counties. I'm trying to get out more to see clients and get together with you. So there's that. I just want to make sure everybody clearly understands there's still an active office in Nevada. Stephanie is staying here. She has no plans to move. Yeah. We are shifting things around. We're growing very well thanks to you, our clients. We had a record year in growth of our portfolios and certainly the amount of money we manage. That's number one. Number two, I did find some time last year to put out my investment atlas 3. So we are going to be doing some book signings throughout California and in Nevada, maybe also Salt Lake City. So anyway, just to let you know, hopefully you will be invited. It will happen sometime later this year. But we are going to definitely, hopefully, get together with all of you and you get a chance to talk about our views on things. The other quick thing, just to let you all know, we probably will also have an investment conference in Las Vegas. If we have time, we might do it later this year, but definitely spring next year. So any of you who want to come out to Las Vegas and go on vacation and have a reason to write it off on your taxes, I'm giving you the perfect opportunity to come play and get a tax deduction. So
Well, we're also trying to do some client appreciation events this year.
Absolutely.
In Marin, in SoCal, in Vegas. We want to try to see as many of you as possible. We know that post-COVID, it was definitely very hard to get together with people. We're trying to make our rounds. We want you guys to know how much we appreciate you. Business has gone very well. The portfolios have gone very well. And we're just really grateful for every single one of you guys that have continued to work with us.
And we have our fingers crossed that that group behind us is going to give us, again, 5-star rankings on our strategies. It's a bit like, yeah, we're going to find out soon. It's like getting grades in college. You sometimes have some surprises that you didn't quite expect, but anyway.
No, we'll do one.
But listen, we hope you all have a good year. And again, it's been kind of a funny start to the year in a lot of respects, but let's just, please be in touch with us if you have any questions. And like I said, hopefully we'll see you all very, very shortly.
Yeah.
All right, take care now.
I guess.